Well, the markets end the week flat, but the mid-caps outperformed. The index has recorded its longest gaining streak since September 2022, up for 10 straight weeks. In fact, the index posted a record close on Friday. Hello and welcome to the Editors Roundtable, where we take stock of the week gone by. We tell you why FIIs are overweight on India and do a deep dive into India's telecom landscape. I'm Sonia, and today with me I have the editors Prashant, Reema, and I have Gautam Dugar of Motilal Oswal here with us in the studio as well. Gautam, thanks a lot for joining in. This market has been really range bound, right? I mean, give and take everything, this 18,600 mark is something that's just not getting taken out, and it's been testing the patience of investors quite a bit.
You know, Sonia, it's crazy the kind of market we're in. The Nifty this week is not nothing, but the small cap index is, if anything, picking up pace. Friday to Friday, it is up 3%. And last week, it did about 2.5%. So the rally, I mean, actually from the lows of March, I think the mid-cap index is up 14-15%, and the Nifty is up almost about 8.5%. So while large caps, as you say, are stalling at about 18,500, 18,600, broader markets, no such problem. It's rich, it's varied, it's backed by volumes, and it's quite something.
Actually, the headline index was disguising a lot of the action that took place in the broader markets. So, before I come to you, Gautam, I just want to quickly put the setup on board for our viewers, right? In case you missed out on all the action, it was largely a range-bound week for the headline index between 18,100 to 18,600. This 18,600 level is just not getting taken out, and that's what we saw in the week gone by as well. The Nifty ended absolutely flat this week, but let's not forget, the Nifty is now up 10%, almost 10% from the lows that we saw in the month of March. So in some ways, this is still a buy on dips market, although we are facing a bit of hurdles at the top. Now, the mid-cap index is where all the action was this week, right? So as Prashant was saying, a record high for the mid-cap index, up for the 10th straight week. And if you're looking at individual pockets, there were a lot of macroeconomic indicators that were very favorable. So whether it's auto sales, the two-wheelers have picked up in a big way. The manufacturing PMI data was strong. The GDP data came in better than expected. The GST collections have been very good. So in that context, Gautam, welcome to the show. This is a fine market to be in, right? Record highs as well as good macros.
Yeah.
But the big question is, can we build on to these gains?
So, Sonia, look, macro is something which was a challenging feature for last 2 years. And therefore, the GDP data which came in 2 days back has come as a breath of fresh air. Because 7.2% GDP growth for a full year FY23, and if you talk about 6.5% for FY24, it does provide a very good backdrop. Secondly, the fiscal balance sheet is in a very good shape. Your current account is under control, crude oil prices are under control. You mentioned about a lot of macroeconomic data points, PMI, GST, auto fuel sales, a monthly data which keeps coming, that's showing, flashing a bright light. And in that context, this quarter's earnings season has also been very strong in the sense that the growth was 4-quarter high. You saw 16% growth for Nifty. On a full year basis, we ended at 11% on a high base of 34%. Right? The problem, however, is the growth is led by still very few sectors. It's banking and auto. The rest of the sectors need to come and participate now. Consumption, IT, pharma, some of the global commodities. So growth is good, but it's very concentrated in few sectors. So therefore, at the beginning you mentioned about very flatlining of the markets, right? Look at it this way, in October 2021, when markets first hit 18,500, the valuations were 21 and a half times. Today, as you look at 18,500 again, 1.5 years later, earnings are up anywhere between 20-25%. So your valuations today is at 19 times FY24, and in 3 months' time, you will start discounting FY25 also, where you are right now talking about 16.5 times or 17 times on PE. So while the levels have been flat, the valuations have become much more lighter, and therefore it provides a good backdrop for compounding for next 2-3 years if earnings were not to disappoint. Thus, macro being good and growth coming back in some of the mid-cap, small cap, because the aggregates sometimes tend to deceive a lot. If you see the broader picture, various sectors, you will find a lot of good results which have come in. And now you have in FY24 beginning, a lot of commodity prices are coming up. So you will get a good uplift in margins as we move forward in FY24. So I think the picture is looking quite good now.
Gautam, while the absolute numbers are growing, as you said, compared to last year and compared to the last couple of years, expectations are already very high, right? Isn't that the problem? So if you take the NSE 100 companies, right? 60% of companies saw earnings upgrades during the fourth quarter earnings season. But even with that, 51% of that same 100 group saw earnings for FY24 downgraded. 60% earnings beat, but 51% of the same group saw earnings downgraded, which means basically that earnings surprises are no longer, a factor for sort of upgrades, because starting expectations are so high. Is that a problem?
Yeah, that's always a problem, Prashant. But look at it this way: in the last 10 years, if I take you back to 2010, 2010 to 20, you had a very familiar problem. Wherever you started, markets, the earnings disappointed. 2021 broke that tradition. 2021 was the first year when earnings got upgraded. 2022 earnings expectations were met. 2023 again we have seen a downgrade. If you look at Nifty EPS, a year back when we started FY23, we projected 870 rupees, and we have ended at 810 rupees. But look at the way FY23 panned out. You had a war. You had a huge spike in commodity prices. Interest rates were raised 250 basis points, and you were contending a very high base of a 35% growth. Despite all of that, instead of 17% growth which was projected, you still got 11%. I think it was a pretty decent performance. Moving forward, again, it portends a big problem because some of the sectors are still struggling. For example, consumption is still in doldrums, especially the rural side, which is where you need to see some pickup, because now you're heading into an election calendar and governments will be very sensitive to ensure that rural consumption picks up, because you have 4 big state elections in 6 months, followed by, it culminates into the 2024 general election. Second, IT, there is a problem, but it's a global problem, which I don't know when it will get solved, 1 quarter, 2 quarter. So these are the 2 or 3 sectors which needs to come and join the party. Otherwise, banking has done its beat for last 5 years. Earnings are up 5x in 5 years. Here on, you will see 17-18% growth, which is still very good because it's coming on a high base. But that alone cannot pull the index up. The good thing is auto is coming back. Auto has come back after 5 years. So some of those problems will remain. And that is where the job of a capital allocator comes into the picture. Otherwise, if everything is good and everything is getting upgraded, the role of a capital allocator in generating alpha will become mundane.
So what's your expectation for FY24 earnings growth? FY23 was 11%, and the heavy lifting was done by banks and autos. In FY24, your earnings growth expectation, and which other sectors will fire?
So FY23, just look at it this way. You saw 11% growth. Without financials, the growth was 0. Right? And without commodities, the growth was 30%. So commodities have dragged the growth down in FY23 and banks have pulled it up. FY24, as you move forward, the headline number will be somewhere about 18-20%. Without commodities, it will be 14-15%. Right? It will be led by banks, as our current estimates suggest again. Auto, we are expecting consumption to come back, which is why we made an overweight call on consumption a month back. It was a neutral call for us 2 years. The reason is we think the base is very favorable to consumption now for after 2 years of a continuous subdued trends in rural side. Second, your commodity prices have come off. And we think that 3.5 years of a time correction in consumption stock does provide a good backdrop to add it back into the portfolio. So these are the 3 sectors. And then at the margin, you will see some rebound from the absolute bottom in sectors like metal, sectors like oil and gas. They will contribute. And rest of the sectors put together, while they do not contribute much to the index weight, but they will chug along at 10-15% kind of a growth. And that's how you reach a number of 16% for Nifty without commodities.
Okay, 16% growth. Got that. Gautam, just stay on. Prashant has put together some data for us. According to an EPFR survey, FIIs are consensus overweight on India, and I'm sure the bulls always like to hear that, right, Prashant?
Sonia, that's the thing, right? Everything is at upper circuit, right? NPLs are low, NIMs are at peak margins for banks. Earnings growth is firing, and it's official now. I think we can officially say this is published in so many words by EPFR, which tracks global flows and global funds, etc., that India is a consensus overweight market for foreign portfolio investors. This is a report published today. So that's interesting. What they did basically is that they surveyed 57 emerging market fund managers. This is basically, they have a definition for what constitutes consensus overweight. But according to that, India is now a consensus overweight market. India is, by the way, the 3rd largest weight in the MSCI Emerging Market Index, right? It's got just under 14% weight. And MSCI Emerging Market is important because, it's a global benchmark. Asset allocators use that to put money according to the weights that countries have. And flows into emerging market funds has also picked up. The data will be up on your screen. Year to date, we've seen some $38 billion of flows come into these emerging market funds, and we get our 13.7%. But now that we are overweight, perhaps it's more than the 13.7%. Could be, I think about 14.5% or so. There's some other detail in this report that say that sectors in India that significantly outperformed for these funds are consumer discretionary, consumer staples, and India IT. I mean, these are the three areas. In terms of the style which is doing well, according to this survey in India, they're saying volatility, reversion, FCF growth are outperforming. Dividend yield, sales growth, and earnings momentum are key underperformers. So that's interesting again. And there are some other numbers in terms of flows, etc. So, Gautam, I kind of go back to that same point again, right? Burden of high expectations, right? We have to lift it, and there's no other way.
So I have a counter question. When was the year when India had zero expectations? And last 10, 15 years, whenever you begin the year, expectations are always high.
Yeah.
It's a different matter that whether those expectations are met or not. So 2010 to 20, those expectations were not met. There was one or the other crisis. We are lurking from macro to micro to commodity to geopolitical crisis.
Post-pandemic, for a year or two, we met it. We met those expectations.
In fact, 21, we have beaten those expectations.
But do you think that will continue? The 21 performance will continue, or will again fall back to that 2010 to 20 kind of performance?
No, I think it will be a very calibrated journey from here on, because now you're not living in a very unprecedented kind of situation anymore. Touch wood. Second, expectations will always run ahead of the actual delivery, because people will go back to the memories of 2003 to 8, because you're seeing capex cycle coming back after a long time. Manufacturing, it is never part of the conversation for almost a decade.
Absolutely.
Right? It's now part of the conversation. And expectations have to be high because you're living in a very different world today. When was the last time you saw PSU banks reporting 0.6, 0.7% net NPA and 17, 18% ROEs, right? So investors are...
Massive. Yesterday our colleague Abhishek did that story on Bank of Maharashtra, and we were just joking that 10 years ago, if somebody said Bank of Maharashtra, I mean, you don't want to look at the bank, but a bank like Bank of Maharashtra has got is cleaned up in such a massive way.
Yeah.
And I think
the total profit pool, in fact, it used to be a loss pool till FY18 for PSU banks. Now SBI alone has done 55,000 crores of profit for FY23. So total PSU bank profit pool has crossed 1 lakh crore.
Yeah.
So these are very different times, and therefore expectations will always be high.
On the point of expectations, Gautam, we spoke with S. Narain. I want to just make you hear what he said. He's, of course, someone who manages nearly $70 billion in assets at ICICI Prudential AMC. Well, he started by saying that India is perhaps the best structural story, but which also means that valuations are higher. And, he struggles as a value investor, what to buy, really. There's nothing which is at the lower end of the cycle, according to him. Listen.
India is the best structural story at this point in the world, because you have a very, very powerful macro. If you look at fiscal, current account, inflation, growth, the entire dynamics at this point of time is extremely supportive at this point of time for India. And geopolitically, we are also very clearly in the middle, and that also helps us a lot. In this stage, the biggest challenge for someone who is more value-oriented and contrarian is what premium do you give? And that is the challenge at this point of time. So are we in a situation where it is possible that we have higher valuations than before? It's quite possible at this point of time. The Japanese central bank has been printing a lot of money in between when they bought bonds, and when the Silicon Valley Bank and the First Republic Bank issue happened, again, the Fed actually gave a lot of money again, but not at zero rates to the system. So I think in between there has been, again, a lot of money dispensed by the global central banks. Again, I think they're going to stop it. So our view is that, we are in a lower return environment because, first of all, you have to remember, across the world, we are not in a zero rate environment. So you can invest in debt and get 4-5% very easily across the world, except in Japan. And we think even in Japan, it's possible that at some point of time, they'll say that we can't keep on printing money in the scale that we have done. So what happens is that results in a situation that we will move to a more moderate rate environment. Top end of premium consumption is in great shape. Over the last few years, it's done extremely well. and there doesn't seem to be the top of the cycle yet reached. But it's again tough from a valuation point of view how to buy it at this point of time. The tougher what we're doing at this point of time is saying, okay, we will not sell it. But how do you buy it? Because if you look at most of them, they have actually gone up more than 100-200% over the last 2 years. And that's why we would say that we would not buy it right now, but maybe we won't sell it.
Okay, well, that's a view coming in from S. Naren. But let's get back to Gautam with a couple of sectors that stood out this week. You know, we were talking about two-wheelers and the auto space. It did very well.
Yeah.
And after so long, finally some respite, right? Especially in the domestic market. Yeah. But what about stocks? Is there more upside here? Because a lot of these stocks in any case are at 52-week highs.
Yeah, so Sonia, look at it this way. This is a cyclical sector. And it's a sector which has not performed for 5 years. Yeah. And look at FY18 to 23, the auto sector profits in Nifty have gone down by 20%. It's exactly the time when banking profits went up 5x. So this is the first full year of a profit growth for auto companies in Nifty. In fact, I was looking at two-wheeler companies' data today. If you look at the earnings growth on a 5-year CAGR, barring TVS, all other two-wheeler stocks have hardly done mid-single digit. In fact, Hero has posted a negative CAGR on earnings for the last 5 years. So I think if a sector which is cyclical and has gone through tough time for 5 years, it's just about breathing again, I would expect at least 2-3 more years of growth, not just in two-wheelers, four-wheeler as well as CV, which is why we had a view that in January 2023 that this is a sector which can make a comeback after a long time, and which is when we went overweight on that sector after being underweight for quite a long period of time. You saw the results of Tata Motors, you saw the results of M&M and a lot of autocom companies. In fact, in this quarter after financials, auto is the sector which has led the earnings up. You know, we were expecting about 70% growth in auto companies in our coverage. We've seen 120% growth. And auto was the only sector apart from financials, again, which has seen an earnings upgrade. Second quarter in a row. This is a sector which has gone through 15 consecutive quarters of earnings downgrade. And now we have seen just 2 quarters of upgrade. So I would expect the momentum to continue on all 3 segments of automobile sector in India. Of course, there can be some period where there is a time correction or a consolidation. But I think the journey is, the direction is at least upwards.
Okay, the direction is upwards. We like that. Let's slip into a quick break. On the other side of the break, we'll take stock of India's telecom landscape and how the telcos are faring. We'll talk more about that sector as well in just a bit. Stay tuned.
Welcome back to Editors Roundtable. We spoke about the banking sector, we spoke about the auto sector. Now let's turn our attention to the telecom sector. It's not often that we talk about the telecom companies because there are just 2.5 of them right now. But I want to put on board how the performance has been in the quarter gone by. For starters, and that's the big takeaway, revenue growth for the telecom companies, the top 3. We're talking about Bharti's India Wireless revenues, Reliance Jio and Vodafone Idea. Revenues for these 3 players has declined to a near 2-year low. Revenue growth was a modest 1% on a quarter-on-quarter basis and just up 10% on a year-on-year basis. And this is the slowest growth that we've seen in the last 7 quarters. The reason for that is a lack of an ARPU uptake. So the last time when we had a big price increase in the prepaid category was in November and December of 2021, which basically means 1.5 years ago. The entire benefit of that 20% price increase has flowed through already. And this quarter, the average revenue per user for all these telecom companies have been absolutely flat on a quarter-on-quarter basis. So revenue growth has slowed down, and if revenue growth needs to pick up from here on, we need to see a price increase, the prepaid 4G tariff increase. Amongst the 3 players, this time it's Reliance Jio, which has clocked in a slightly better growth at 1.7% growth on a quarter-on-quarter basis. But year-on-year, Reliance Jio and Bharti's numbers look fairly comparable. The second big takeaway is the capex spend by Vodafone Idea, and that has dwindled just down to 3,360 crore. This is the lowest spend in terms of Vodafone's capex since its merger in 2018-2019. And Vodafone Idea's capex spend is about 7 to 12% of its peers. It's about 7% of Reliance Jio's capex and about 12% of Bharti Airtel's India capex, which basically then raises the question is that if we have such a sharp divergence in capex between one player, Vodafone Idea, and the other, that's Bharti Airtel and Reliance Jio, will we see an acceleration in market share loss? Will pairs like Bharti Airtel and Reliance Jio further gain market share? They anyway have been over the last many quarters now. The market share gains have been quite phenomenal, close to about 2% each for Bharti Airtel and Reliance Jio over the last 2 years. But is this something which is going to continue? So that's been the big takeaway from the telecom space. One, the revenue growth has slowed down in Q4 for the Indian mobile wireless space, for the lowest that we've seen in the last 2 years. And second, Vodafone Idea's capex is at the lowest level since its merger, and it's just a fraction, 10% of what peers like Bharti Airtel and Reliance Jio have done in terms of capex, which raises the prospect of more market share losses. Gautam, any thoughts, Bharti Airtel, it was considered to be a darling. Everyone recognized the kind of potential Bharti Airtel has. Yet the stock has not delivered the kind of returns. There are so many target prices which are in excess of 1,000 rupees for Bharti Airtel. Do you think, how do you see the next 1-2 years? Is this the kind of company which on an aggregate will just give you a 10% type of share return?
So Riba, the problem with this sector is the lack of meaningful ROE and free cash flow generation. I mean, hardly they generate free cash flow beyond a point, because every now and then there is a big capex lined up. Your technology is evolving, so they have to be one step ahead of that. And then there is a massive competitive intensity, and then there are different regulatory headwinds also which keeps cropping up. So if you look at the ARPU journey for last 3-4 years, it's hardly done anything, right? So if the sector has to do well, you at least have to get some semblance of consistent ROEs. Otherwise, it will remain cyclical, It will depend on a quarter-to-quarter kind of a journey, where if the company has taken a price hike, if the discounts have reduced, you see a rally, and then again you fall back to the same old ways, because it's a heavily leveraged balance sheet for all the companies in that sector. That's why the weightage in index and portfolio you will always see will be very limited.
I think just 2.5% in terms of a nifty weightage
yeah,
for Bharti.
Absolutely.
But Gautam, I want to ask you about one of your big calls, and that was ITC. I think in the month of January and February, you went around saying that ITC should be a big portfolio bet, and the stock has done very well. Year to date, 33% higher. In the last 12 months, it's gained close to about 60%. But our colleague Mangalam put up quite a compelling case, saying that is it time now to start looking at HUL? One, because HUL has underperformed ITC over this period of year to date or last 1 year. There's a new CEO coming on board. The kind of discount ITC used to trade at versus HUL has come down quite significantly, and plus we're hoping for a rural recovery. So do you think the best of ITC may be behind and it's time to look at HUL?
I would think ITC can still give you compounding returns, because the P at which it was trading at a year and a half back at about 15-16 times, 6%, 5-6% dividend yield, that early sort of low-hanging fruit has been plucked. Now you're talking about a 23-24 P, which by the way is still very lucrative given where the sector is still trading at 50-45 times, right? But large part of the re-rating seems done, and here on you will see compounded returns which will be backed by underlying earnings growth, which by the way is still looking very good at about 15-16% CAGR. This year when we started the year, we were projecting a 17% earnings growth. ITC has done 26%. Yeah. So throughout the quarter, throughout the year, you've seen earnings getting upgraded. Relatively, I would still feel that ITC can keep giving you market-beating returns at least for another year. Within the sector, possibility of HUL now outperforming ITC, it opens up because commodity prices have come off, and rural consumption we do expect to improve from here, and not just lever. I think possibly Godrej Consumer, Britannia, some of those names can also start performing because they've been range-bound for some time now.
Okay, well, with that, it is a wrap. Thank you so much, Gautam, for joining in. And thank you to all our viewers for staying tuned into Editors Roundtable. Have a great weekend. See you again on Monday.